great if you could quickly introduce yourself, about your role, your function here in Luxembourg to our audience. Hind, do you want to start?
I'm Hind Gaidi at Astorg, and Astorg is an investment firm where we focus on private equity, especially buyouts. We're in Luxembourg now for around 5 years, and we have a team of around 35 people. And we're located, we have offices in Paris, London, Frankfurt, and New York. And I'm very thrilled to be here today, so thank you, Stefan, for the invite. And in my role today at Astorg, I'm in charge of the investments. So I monitor the portfolio companies, and I'm also in charge of the financial communication to our investors or prospective investors in fundraising.
Thank you, Hind. We also discussed the COVID-19 pandemic has hit by surprise our economies and businesses. What was the impact now on private equity managers like you, your portfolios, and also what actions have you taken now and put in place in response to the crisis? Hind, do you want to share with us your thoughts?
I'm happy to take this one, Stefan. Thank you. So indeed, at the beginning of the crisis, what we have looked into and considered is the stakeholders managers, and who are our stakeholder in this situation. So it's our employees, our portfolio companies, so our investments, and our investors, obviously. So in terms of employees, what do we look into? As most of the people that are watching us today, you want to have your employees that are safe, that can perform their work remotely in an efficient manner. So that has to be guaranteed, business continuity, obviously, and also in line with certain regulators, depending on the countries we're in. So once that's secured, where we look into is obviously looking at our investments, portfolio companies. And as we were alluding to earlier at the great financial crisis, maybe that we were taken by surprise, and since then what we could see is that most of the investors have developed a playbook to say, when we are in firefighting mode, what are the things we will be looking into? What are the first actions we do? So that's where we go. We put that on play for 3 weeks, and we just make sure that we have drawn our RCFs, that our furlough as offered by the governments is put in place for our employees. That I mean, in this specific situation, if you had industrial companies or manufacturing sites, we had to make sure that there is the social distancing that is respected, etc., etc. So that's the firefighting mode. That was probably shorter than in previous crises, because we had the playbook that was put in place, and once that's under control, then we want to sit back and then really think about what are our short-term actions beyond what we just did, and to protect the value, and are there other ways to enhance the value in these situations. And there you have to sit together with all the partners that are following the deals, but also with the management. A very good deep dive on what are the systemic changes and what are the temporary changes for our investments, and to understand exactly what, you have to form a view also on the curve or the recovery curve. And of course, nobody has the crystal ball at that point in time, but once that view, then the communication goes to all our management companies, to all our invested companies, to explain if we want to develop a view which is applicable to the whole portfolio, we have to have this curve that is applicable to all the portfolio companies. Be it that it can be different for certain industries, it can be different for certain regions, but it's the same, conceptually speaking, is the same one. So that's where we poured a lot of effort and a lot of time. And in the meantime, our third and one of the most important also stakeholders is our investors. So when do we communicate? How do we communicate? What kind of detail do we communicate? And there you have to find the sweet spot in terms of don't communicate as early as possible, but maybe not too much in detail until we know more. So be transparent, say what we are busy with right now, and once we had our mindset where we were aligned with our investments, then we went back to our investors and we took really the time to reassure them, to explain where we are today and what we see in the near future. So that was the approach 3 three-pillar approach. Let's call it this way.
Peter, Bjorn?
Yeah, I still have the mic, Peter, so I'll continue with this one. From the LP perspective, so the fund of fund perspective, the investors in the funds like Hindi's funds, we have seen exactly that. More experience at the GP level. Within a couple of weeks after the lockdowns, we started to get overview of what the portfolio was looking like, how the portfolio was doing. Of course, for us, that was very useful information to see what we were probably needing to buckle up for. Are we going to see a fall into the abyss, or are we seeing actually an environment of GPs that can weather the storm? And it's clearly the latter. We've seen that the GPs are prepared. From our perspective, we also wanted to make certain that our teams were safe, that people first, that everybody's health was safe. So we went into teleworking, we reduced travel, or we abolished travel for the time being. And we, of course, want to make certain as well that we continue to play a role as a partner, as a sounding board, but also if there's GPs of us that say, look, we could need more money here or there, that we were relaxing terms for recycling, that we were available to have discussions on opportunity funds or continuity funds. So all those were actions that we have taken on our side to continue help the industry weather the storm. We've also at the EIF side implemented some of the corona countermeasures on behalf of some governments and also on behalf of the European Union.
Now quick switch to Peter.
Thank you. Yeah, and I think Hind and Bjorn touched on the most important parts. The playbook is something that we definitely had, and that's super important because that allows you to react. Did we expect anything like the COVID-19? No, that was not in the playbook, but more the approach. So the financial reporting from the portfolio companies, we beefed that up. That was a very tough exercise on the portfolio companies to get the bi-weekly reporting, make sure that we have the cash available in both in the funds, in the portfolio companies, understand where the sectors are that have the most headwind, where you have the sectors that you have the tailwind. I think that's one part of the equation. The other part of the equation I think is even more important, and that's the mental well-being for those people that work in those portfolio companies, but also the people that work with EQT. And I think that's something where we've learned a lot in the past months, and we've really been trying to find the right way to approach it. I think offices are still closed. How do we reach our people, etc. But we find something every day to improve that and to continue to monitor that. So I think those are the important lessons there.
Thank you, Peter. So the private equity and venture capital industries are showing again their resilience and capacity to recover rather quickly. But do you foresee now any changes in your own operations and also way of analyzing things? Peter?
Yeah, I can kick off. I mean, I think the obvious thing is that, I mean, if I take myself in my 20+ year careers, I had never worked a day from home until the start of the year. And I think I realized that it's actually working really, really well. And on the same token, I was in a plane at least once a week, if not more. And I haven't done that for a long time. And I think we see that business is running almost as usual, I would say. So that makes you think. And I think it's a crisis. It requires a crisis or a new generation to make that step. So I think that's something really, really important, where I'm sure that my goals for next year, from a personal perspective, will have those two elements in there: working from home at least part of the time, also making sure that my travel is going down. So I think that's more from a personal perspective, from how we look at the world. I think it will also enable us to really wake up and then understand how can we make an impact as a firm, how can EQT make an impact. So from an investment perspective, that's something that we're really going to focus on. And I think thirdly, you want to make sure, just like we did after the global financial crisis, what's the sectors and what's the trends that we will see that will thrive from here, and how can we continue to outperform the market by investing in the right sectors and on the right trends.
Any of you would like to comment?
So indeed, where the way Peter frames it is the resilience is beyond only PE or venture capital. There is personal resilience in people, in the employees, and there are also figures that show that there is maybe PE resilience or what we see in the markets. That having said that, I do not find that we really rely on what we see in the markets today to say that our portfolios are resilient, because we are rather long-term investors, so we have a long-term approach. So there we clearly see that there are some industries, there are some sectors that have shown higher resilience than others, and that was not maybe visible prior to in other crises, because the drivers of the crisis this time are very different, because we have people that are at home maybe consuming more or using more of something. So you have seen that the Netflix of this world and the Amazons of this world are completely exploding, whereas something like airliners, it's the opposite of that. And those drivers, we've never, I don't think there was a stress scenario where we thought nobody will travel, nobody will go out of their houses up until today. So this is extremely valuable experience and data for us. But beyond the data, there is a resilience of the businesses of saying there is a complete paradigm shift. So is our operating model still valid for the future? Or are there initiatives that we maybe have thought in the next 3 years that we want to maybe put in place already now? So it's a complete strategic shift there. Now it's very reassuring to indeed look at your portfolio and see that you haven't lost value or only limited value or less than what you expected based on the first stress test. But that doesn't really change the view of the long-term investor and of the value creation, because at the end of the day, that's where we want to be the most present.
Bjorn?
I hope the mic works now, yes.
Yes.
Well, I would like to quote Winston Churchill, who once said that never let a good crisis go to waste, and I would hope that we see this crisis as a catalyst for change and embrace an opportunity to change a bit the way that we do business. Indeed, by being more mindful about whether each business trip that we're doing is needed. Also about office space, I know within the EIB group to which EIF belongs, there's also considerations as to what will we do with the office space. Do we need all the office space here? Do we need to send X thousand of people with the car into the Luxembourg city center? So those are reflections that are going on that are healthy. Now, unlike direct investors, as a fund-of-fund investor, the only asset that we can really invest in is people, are the GPs. And I cannot do a virtual DD on a piece of software code like some of my tech investors can do. The only piece of due diligence I can do is on the lively DNA and people that I have around me. So the one thing that has impacted EIF's business a lot, as an investor that also supports first-time investor teams, is that before I give a team 10, 20, 30, 40 million euros, I would actually like to see them in a real meeting. And that sometimes is not possible over a Zoom or over a Skype chat. So there, I would hope that for new teams in the market that we would like to back, there is a return to some kind of new normal where I would still be allowed to travel and go see them and meet them in real person to see whether they're worthy of our financing and backing.
Thank you. I'm persuaded that Andrea would also have loved to share his insights on that part. We'll certainly do a catch-up in December, probably, with the new GP series interviews. We will start with the association. So lots of space then to discuss those topics and integrate also other new ones. Let's get now a little bit more macro. Countries had to react in order to save the economy and have therefore put in place unprecedented and in some cases unconventional measures, including, for example, lowering rates, providing loan guarantees, bond buying and liquidity lines. What are your views about the ultra-low interest rates, QE infinity macro environment, and are you concerned about the level of leverage in the system, both at corporate and sovereign level? Yes, Bjorn, if you want.
I don't have the real, I'm from the tech side, so the leverage is something that is hardly existing on the tech side, but I do see that, and I was not aware of this, but apparently the liquidity levels that have been made available by governments during this crisis are a magnitude of what has been going on in the financial crisis. And already there we had a lot of quantitative ease and liquidity provisions by central banks that made that economies and countries were kept afloat. Now, of course, governments now as well are indebting themselves to make certain that the lockdown measures are mitigated by the people that are suffering the most from the lockdown. So clearly, somewhere down the road, governments will have to deal with it. But if there's one thing that we've seen from the global financial crisis, and we're based in Europe, we're at the heart of Europe, and I work for a European institution, is that I do think that the European Union is capable of also together as a union weather this storm and make certain that for the members of our club, if I can call it that way, there will be solidarity and a way of weathering this storm as well. Now, on the positive side, all this liquidity shows that a lot of money is flocking into the stock market, that levels are now back to pre-COVID levels. And actually the one thing that seems to be a guiding line for the future is that if you're not investing in technology and innovation, you're probably missing out on the one thing that is going to save us going forward as well. Sorry if I use a second quote, the best way to predict the future is to invent it. Invention is technology, venture capital is financing technology, so anybody looking for good investments, look at the tech side and you'll see that the stock market will also there give you good returns.
Anything you would like to add on that topic specifically?
But I think I mean, we don't have the crystal ball, of course, and it's very, very, very hard to predict. I think inflation is something that we continuously monitor very, very closely and to see, and that's going to be the hard part of the game that the institutions and the governments need to play, make sure that they manage that in the right way. I mean, if we get a little bit of inflation, you get if you're invested, you have the inflation that also makes sure that the ownership that you have in the private equity funds and the companies that they own grow with it. So if you have real assets, that's going to be not such a big issue. But if you just invested in debt, and we see a lot of private debt investments, that's something you need to be very mindful of how that's going to play out. Unfortunately, I don't have the answer to that question. It's time will tell, and it's very difficult to predict.
Also, the audience, don't hesitate to ask any questions via the chat function, also to our panelists. And let's then move on quickly to the last one. Finally, GPs, what are you looking for post-COVID deals? And what kind of performance can we expect from pre- and post-COVID vintages?
I'm willing to have a go at this one as well. In our portfolio, so we're exposed to the lower mid-market private equity-wise and to the venture capital market in Europe. What we've historically seen post-crisis is that on the private equity side, typically the post-crisis vintages were some of the vintages that delivered the best returns, because of course you're investing at lower prices, less competition normally. I'm not certain whether we're seeing that already now. So to be seen what the ripple effect will be of the COVID crisis once it's done, whether companies continue to suffer. On the tech side, though, it's less pronounced. I think currently, if we're in a crisis situations, I don't see it in valuations, and I'm not certain that on the tech side, the similarities that have been made in the past, that post-crisis, you have a better investing environment would actually hold up. But normally, if the rule is followed, we would expect that post-COVID crisis years would deliver outperformance.
I'm trying to make sense of why would that be the case. And one of the reasons I can think of is that probably we have a tendency to hold on a little bit longer to the investors, to the investments, meaning that maybe you spend more time also crystallizing or the value creation before exiting. So in terms of at fund level, we're maybe looking at a little bit of a lower IRR, but in terms of multiple, the performance is higher there. But overall, what we see in terms of investments, I mean, you have the first time when fundraising or when starting a fund, there is an investment strategy, and we're in the lucky position, and I think Bjorn as well, that this crisis proves that our investment strategy is on those sectors where we have headwinds and positive headwinds, and then that reinforces our desire to continue doing that. I mean, either be it in the software, technology, or healthcare, or the combination of the latter. I believe if you are in a different type of sector or industry, you will have to rethink it a little bit differently. Or take certain different measures there. Are we going to change our way in approaching investments post-crisis? We don't see the recovery yet, so we don't know exactly what would be our analysis coming from that. Having said that, what we can clearly see already today in our analysis, either be it at the IC level or in discussions when considering new deals, is that where before you would say that an investment is acyclical because it's not impacted by different economic cycles, etc. Maybe today you will have a different lens, you have a wider perspective there. But that only reinforces our strategy in looking at companies that have that are niche companies but have international footprints and that have some value drivers that are not necessarily hanging on one thread. And that's the investment strategy up until now, and I think we will continue with that. And it's very reassuring when you look at the portfolio at portfolio level. We clearly now have developed, maybe that's a good point, we have reinforced our portfolio approach instead of portfolio companies separately, because we clearly see that there will be a compensation effect between companies that maybe did a little bit less well than others, and there is a good strategic exercise in terms of timing of exits and exits of which companies depending on the sectors they're in and depending on the expected recovery. So that's clearly an exercise that has become really important.
I think what is very interesting about what's shown this crisis, that diversing your portfolio really, really works, because you see, as Bjorn mentioned a couple of times, that tech's really thriving and there's other sectors that are thriving from this crisis, and that there's other sectors that, take the hospitality, that take a real big hit. So, if I take one step back and look at the equity portfolios, yeah, we have a few of those companies, unfortunately, but we have a very diverse funds, and most of the trends that we have invested in are actually benefiting from what we see happening today. And I think that's basically the answer also, that the COVID and the post-COVID funds, they will abandon certain sectors, so there needs to be different way to finance those sectors, and those sectors need to reinvest themselves to make sure that they're going to be profitable again. So I think the future looks bright for alternative investments.
Good, and I just heard from the team that Andrea's sound problem has been solved, so he will be able to chip in now. So that's the red carpet. Andrea, you will be able then to answer directly the 3 questions if you want. So a good compilation of GFC versus COVID-19. Secondly, what have you put in place? And thirdly, the performance pre and post-COVID.
I said, I think there are some similarities between the 2 crises, but a lot of differences as well. I would say the policy response in particular is a big difference, both monetary and fiscal policy. So the recovery shape that we've seen in financial markets, and to some extent also in terms of operating metrics, has been so far more like a V-shape than the U-shape we had before, although there are all sorts of shapes that have been discussed, the K-shape for certain businesses, the L-shape for others. In all this, and something that the panelists have highlighted before, a big difference has been that GP seems to be much more ready. They've very well proven playbooks that were put at work immediately. From the perspective of a fund-of-fund player, we've seen also some similarities in terms of the thinking and the action that were undertaken by the GPs. There'd be clearly categories of assets, from like intensive care assets or sick but okay or healthy or even benefiting assets with different actions that were put in place depending on the sector. Sector divergence has been clearly a theme that makes us think that, yes, market might be rational, but to some extent they are rational, because you could see that even for public stocks, there's been a huge discrepancy in the performance of stocks in different sectors. So it would be interesting to see how it pans out. We started the crisis from historically high valuation. If you look at the CAPE, the cycle-adjusted valuations, and now we're at a situation where valuations mostly, in aggregate, even higher than they were before. The easy explanation is low interest rates, and that was another question about the mountain of debt, the quantitative easy infinity that has been taking place. And to me, that is indeed something that has to be considered in new investment activity and running existing portfolios. I mean, there have been 20% of all the dollars around have been printed this year. There's 14 trillion of non-financial corporate bonds and debt out there, which is twice what it was in 2008. The quality of credit is less than it was, and inflation is nowhere to be seen. I don't think there is a risk of a Zimbabwe scenario, but there is a possibility that at some point there will be pressure from wages or commodities or cost of imports. So we'll see. I think at the moment, the financial conditions are very supportive. The banking system was much better equipped than last time around to deal with the situation, better capitalized, but the low rates are here to stay, it seems. There's no exit strategy to quantitative easing. Will also put a dent, will be an issue for banks' profitability, which are important. There's also the problem of zombie companies. There are some companies that should, in normal circumstances, should have gone bust, and they're not, and that could affect the productivity of the economy overall going forward. And also tech stocks, very resilient, doing extremely well. This is also related to the low rates. When 200% of your value comes from terminal value, of course, the lower the rates, the better valuation for these assets. So it's an interesting environment. And the last question was about the expectation regarding returns. I think there was a survey across more than 100 GPs over the summer. They were saying the COVID crisis would probably cut IRRs by 4 or 5% on existing investment and money multiple by 0.2%. By now, 3-4 months later, probably the view is that there will be hardly any impact on money multiples, but as said by the other panelists before, possibly in terms of rate of returns, because there have been some exit, longer investment horizon is something that you can clearly expect. Will the vintages, post-COVID vintages, be better than the previous one? Historically speaking, when there was a macro downturn, private equity was able to generate very good absolute and relative returns. So able to outperform public markets by a wider margin and also generate very strong returns. Jury's out about the current situation, because you can see for a number of sectors that there are, depression type earnings and booming time valuation. So you need to be extremely careful in selecting, in assessing various businesses. And you clearly have to look at portfolios. Portfolio construction is extremely important, multiple levers of value creation, downside protection, and as said by co-panelists, it's important to look for assets which are not a one-trick pony, but offer multiple levers of value creation and look at scenarios to deploy capital. But you still have to deploy capital. You cannot afford not deploying capital if you want to also diversify across vintages, which is one of the key to generate attractive risk-adjusted returns. Apologies for the long answer.
Good. Thanks a lot, Andrea. Very happy to have you. And then we are back on track.
Thank you.
So it's really the occasion now to ask your questions to those experts here present. So the first one is, who are the winners and losers of the COVID-19 crisis? And would it be possible that some VCs would be kind of scarce of cash? Who wants to answer that one?
Yeah, to me, everybody offering solutions to deal with a digital lifestyle will probably be in the winning category. So why is life almost going on as normal when everybody is in lockdown? It's because there's an increased digitalization of our economy. There's online consumption, there's digital entertainment, the Netflixes were mentioned. We have Spotify reaching a 50 billion market cap during the COVID timeline. Gaming companies are booming all over. We had a Turkish company, Peak Games, was one of the best exits we've ever had in our portfolio, sold for close to 2 billion to Zynga. So those are the observations that I make, and I want to stop talking only about tech, but any company that offers a solution that makes the current situation livable. And actually what you have learned during a stress period, it's always when you face the abyss that you change to survive, and mankind has always done that. So also here I think that those people, those companies, even in traditional sectors, that manage to reinvent themselves to deal with a new reality and take the positive elements out of that and actually bring that then forward in the new normal, those will be the winners. And I would not de facto rule out that the people that are in the hit economies now, like hospitality, that they would de facto be the losers. There's also a lot of innovation going on there. When I say innovation, it's not necessarily on the tech side, but business model-wise to try to overcome. And those people that are capable in a Darwinistic way to adapt to a new reality, those, according to me, will be the winners. As to the question, is there a possibility that people run out of money? Yes, of course that happens. We need to understand as a fund of fund investor why people are running out of money. If it's for reasons that are totally understandable and are actually then in need of money to be more aggressive rather than defensive, we would be even willing to back that. If we need to put good money after bad money, that's the type of running out of money that we wouldn't like to back.
Bjorn, you mentioned tech sector and other sectors. That's also a nice angle. Peter, Hind, do you want to comment?
Yeah, no, definitely. I mean, I think maybe even a step before what Bjorn was mentioning, and of course we're talking our own books. We invest a lot in fiber, and I think those enablers of what we see happening today, making this video conference possible, I think that those will be the winners of the crisis. And I also agree. I mean, it's short term, long term. Let's see, because I mean, take real estate as an example, and more like philosophical. If I only need to drive to work 2 days a week, it might actually be worth to live outside the city, where I get a lot more value for my money than if I live in the city. So I might actually consider to buy a house instead of like an apartment. So office buildings, I think that's another thing that Bjorn touched upon. How are these going to look shops that we have? Because you get to the online, how do you want to make sure that you have the experience? How can you mix that off? So it's going to be very interesting, and I think it's very hard to predict the future, but there's going to be some unexpected differences or winners that we don't have inside today, I'm sure of.
Yeah, I think this is an important point. Is also try to uncover the winners of tomorrow, because one of the issues is that everybody wants to be in tech and healthcare nowadays, and one of the reasons why I think that the sector, the private equity buyout at least, has been more resilient than in the past is also that the sector mix has been pretty good entering this crisis. But the question is whether you are paying too much for the winners that there will be winners. So it's always about finding the right angle. And when we would consider GPs or go directly into companies, we always think about a potential edge, an angle, something different that can be brought to the table, that is not just taking the consensus view that certain tech assets or healthcare companies will do well in the future. So as you said, it's important to look forward, be creative, but also I would say not dismiss the possibility that certain traditional sectors that have been beaten down by the crisis might actually survive and do better later on, and cash flow might return as a theme as opposed to top line growth. Because now, if you speak to GPs, I mean, there's a lot of emphasis on turnover growth, revenue multiples, pro forma EBITDA doesn't really matter. I mean, there's some elements of, let's say we've been all influenced by the decade of tech in public markets and private markets. It's done very well. Will there be a reversion to the mean? Will there be a comeback of value stock in the traditional sense? It's hard to say. I mean, Value's been doing terribly also during COVID. But I think one has to keep an open mind because there could be real good opportunities also in sectors that nowadays nobody wants to touch with a pole.
Here we have another question about the long-term impact of this crisis, considering now the economy, unemployment, and potentially also political changes. Any thoughts on that perspective?
We don't have the crystal ball that we were speaking
Without,
about,
yes.
for sure.
Yeah.
There will be, as I mentioned earlier, a paradigm shift in the consumers' behaviors and in also the way we live, the lifestyle, our habits, and the way we consume as well. So there will certainly be an impact. And for me, it's very tightly linked to what the previous question of who will be agile, who will listen first to the market, to their consumers, and who will be able to offer that in the market in a very swift and open-minded manner. So that will be the long-term shift. Are we able to maybe also reinvent ourselves because we see that what we have today won't cut it. We won't be able to continue with this business model. Or you can also ask yourself, is there a value, and I think I have enough liquidity, I have enough treasury to continue with limited activities until the moment the activity resumes in certain industries, like I like always to take the example of airliners, but there we clearly are in an industry which is very asset intensive. Where today, I mean, we still have flights, but not that much. So how are they, I'm very curious to see how are they going to reinvent themselves? How is the economic model will be working for this type of companies? And the same goes for the hospitality industry, for instance. So long-term effects, they clearly will be there at all levels and also at personal levels for us. It's very early to me to say how it will be really changing, but what I can say is that today when we are speaking with our portfolio companies to management, or when we are in our monitoring committee meetings, that's clearly a consideration where we spend more time into encouraging the deal teams, encouraging the management to think beyond the 6 months, to think beyond the 12 and 18 months. I mean, it's something we always have done, but in a more radical way. Can we make those changes? Are there opportunities that we haven't considered before that we are willing to consider and take a bet on today? So that's the perspective.
Just one, listening to what you were saying, just one thought from my side. I think the long-term effect can actually only be positive, but the only way I see that it could be negative is if we don't draw any lessons from the current environment. That would be, according to me, the most devastating long-term effect that we could see, that we just pretend as if COVID hasn't happened and that no lessons are learned from it. That would be, according to me, a missed opportunity. And I think if we don't miss the opportunity, whatever the outcome will be in the long term, it will be a positive one. That may be the half-glass full type of way, but that's the way I want to look at the world as well.
No, I fully agree with Bjorn and Hind there, and I think that's where private equity has an important role to play, to actually finance those transitions that we're going to see. I mean, I'm sure that people still want to travel. They're going to find a way to travel. But is it through the air carriers that we see today? Who knows? And this is the long game, and there's a lot of capital required to change that infrastructure. And I think if you're on the right side of that transaction, you make the right impact, you can make money, and I think you do good to the world. And we need to make sure that we learn the lessons and we implement those. I think another one is and Raja touched upon it, diversifying the workforce, being able to make sure that we have much more flexible, that we don't have these 9 to 5 office hours. I think that should drag a lot of people back into the labor process, and I think that should enable chances for everyone to make sure that we have a very inclusive workforce as well. So I see huge opportunities, and I think we need to make sure that we we take them and then we don't leave them and go on to the old food.
That was exactly another question that was also asked now in the Q&A. It was about this online transition. Will it last afterwards, once we have, for example, a vaccine? And will it not now decelerate a little bit afterwards, so people so happy to come back to more human but also physical exchange?
Well, I think all three of us were very happy, and everyone else here, to see each other in real life. So we shouldn't underestimate that it's important. I think I think the function is definitely going to change, and I think the main reason for me to be in the office from time to time is to make sure, again, what we touched upon, the mental well-being. Everything else I can do, because from home is as good as I do it from the office, because most of the times if I'm in conference calls or etc., my office door is closed. When it opens, I think that's the most important function. So it will change the function. So yeah, it will decelerate for sure, because I haven't traveled at all. And like Bjorn said, I think there's still people that I would like to really meet face to face, and it's important to meet them face to face. But I'm for sure going to ask myself the question every time I book a ticket: do I really need to, or can I combine it, or can I be much more smarter around it? So yeah, let's learn those lessons.
Yeah, I have to agree. Also on the mental well-being part, because indeed there are some people where there will be a cost of mental well-being that is currently taking place, and that we will have to pay after this crisis, clearly. But at the same time, we see some people that have really revealed themselves while working remotely, and that's let's make sure that when we are back to the office that there is this inclusion. I really want to stress that. On the other hand, it will be a pity not to learn from this, honestly. And we clearly saw that a lot of meetings were much more efficient while being online. We clearly saw that people were more punctual when you shifted things online. So that's very good. Now we don't want to be in Zoom, back-to-back Zoom during the whole day. I think we all made that experience, and we all understood that's not something we want. Now the conclusion is it's a hybrid solution, being in the office, but also being flexible, and also being smart about the way we organize our agenda, our schedules. And yesterday I was exchanging with a colleague about how can we do it best. And maybe one of the solutions was you focus on calls at home, for instance, and the days you go to the office, you don't do any calls, and you only focus on the people that are around you. And on the exchange with them. But then we have another challenge, as Bjorn mentioned before, is that we're fundraising right now. And I can tell you that the investor relations team spend their day in carousel meetings, jumping from one Zoom to the other. And as much as there is willingness from both sides to make it a successful meeting, sometimes there are difficulties there. And there will be clearly an upside from being able to meet each other. Maybe not as intensively as we used to do, but at a minimum.
Yeah, I would like to avoid that when we say lessons learned, that we draw a conclusion that we shouldn't be meeting people anymore. We shouldn't have we're humans. We like to meet one another. We like to be in herds as well. Even introverts wouldn't want to be alone on the planet, so to speak. So, yeah, I find it amazing. I'm almost lost my reflex of giving an elbow and rather wanting to shake hands again. So I'm longing for the day that we can. The human side can be normalized again as well, and there should not be any bad feeling of meeting people again once COVID is past us.
So you're making me feel guilty for not being there today with you.
Sorry.
And I have a newborn and a daughter with 4 classmates with COVID at the moment, so perhaps it's a good idea that I'm not with you today. But I agree with everything that was said. There are certainly some structural changes in the way we work and operate. Some will remain. Some might be an acceleration of or pulling forward demand. Netflix results, they said they expect negative subscriber growth next year, early next year. Maybe that will happen, maybe not. But also gives you a sense that perhaps we will not be in perpetuity a couch potato generation, and things will go back more to normal times.
Just two last quick questions. First one concerning your processes. Have you done and used remote due diligence on GPs, new GPs, and investment companies? And the second one, has anything changed on LP reporting during the COVID crisis?
I could take it up quickly. For now, in terms of due diligence, so as a GP, we have due diligence from our prospecting investors. So far, it's all digital. We organize the commercial due diligence meeting, the operational due diligence meetings, everything on Zoom, and everything on the virtual data room. Let's see how it evolves. I think Peter has also some experience to share on fundraising, maybe in the early times of COVID. And now in terms of investments, we also, all the investments, there were no meetings really available. We couldn't really meet with the management teams. We had 2 exits during the COVID and 1 investment. We finally could find some location where people could fly in from the US and from London and Paris, and they all could meet for 1 day at least with management. But it's quite complicated, and indeed when we invest such amounts I mean, hundreds of pages of due diligence reports are not worth one good meeting with management team. So that remains really important. We do it as we can, but we cannot say that one extra report can replace a real meeting.
We would not do a complete new team that never met the people. We would not be able to do without meeting the people. So we would have to be creative to organize, in respect of COVID measures, to see a meeting that we can at least meet the team that we want to back. On the reporting, yes, it's also our auditors. The term COVID questionnaire is something that I have heard way too often, and the impact that it may have or not on our portfolio and the valuation. Yes, there's increased reporting, but quality reporting from the GPs, but also our auditors are far more demanding. And all respect for the auditors, of course, they need to do their business as well, but it's not necessarily making my life easier.
No, yeah, I can only echo what Hind and Bjorn said. Is like recurring LPs, and we actually, I think, in that what you were touching on, we had one fund that was actually launched pre-COVID, so we had done all the meetings, and it continued. There was like a small pause when we had the first wave, but then when LPs saw that this was something that would go away and that the world could keep turning, that they continued to invest, and that was very successful. The other one was actually started in the midst of COVID, and that, I mean, there's 2 sides to it. On one hand, the marketing team said it was very effective because they could go from Houston in let's say in the afternoon to Tokyo in the next morning and have those meetings all from their offices or homes, and it was very, very effective. But if you have new LPs, in our case, that's going to be very challenging because that's where you really feel that the in-person meeting adds the value. I think same on the investment or divestment side. I mean, there's a lot of things that can be done, but that meeting or finding alternatives to that the in-person meeting, I think, is super important. So the networks that we have definitely work and pay off here.
Andrea, final word on your side?
Well, same experience in terms of fundraising. It's much easier with the existing investors that know you and you met in the past. Regarding new investment, one aspect that maybe it's a positive is that because of the digitalization of more due diligence meetings, we happen to have the chance to see a bit more when we do a co-investment where the GP has actually recorded certain management sessions. So in a way, there are also some situations where we can have access to more information that is helpful. But as everybody has said before, there's no substitute for in-person meetings.
Great. So despite this light, bumpy start, we really recovered quite nicely with all the required resilience. Now we will do the morning break, so until 11. So we would recommend to go and visit the different sponsors' booths and also to test, for example, the networking tool. Thanks a lot then to all our panelists, Hind, Peter, Bjorn, and Andrea, for your transparency, your insights, and I'm sure that we could have continued for more than 30 more additional minutes, but we will do that next time. Thanks a lot, and see you soon.
Thank you.
Thank you.